Hello everyone, welcome back to Boss Economic World. I am your host. Today is December 18th, 2025. If you've been following the global money trail with us, you know the rule: when the elephants fight, the grass gets trampled. But what happens when an elephant decides to sit on a hedgehog? Well, today we are talking about the American elephant and the Swiss hedgehog. The headlines today are screaming one thing: Swiss exports to the US surge. The numbers look beautiful. Champagne corks are popping in Zurich, right? Maybe. But here at Boss Economic World, we don't just read the headline, we read the receipt. And let me tell you, the receipt for this victory is long, expensive, and smells faintly of American catfish. Today, we are going to peel back the layers of the US-Swiss framework trade deal announced last month. We're going to look at the new data released this morning by the Swiss Customs Office, and we are going to answer the trillion-dollar question: did Switzerland just pull off the deal of the century, or did they just pay the most expensive protection money in history? Grab your coffee, or perhaps a Swiss hot chocolate, and let's dive into the truth behind the numbers. Let's start with the data that dropped this morning, Thursday, December 18th. The Swiss Customs Office released their November trade figures. If you look at the surface, it's a comeback story that would make Rocky Balboa jealous. The headline numbers: 1. Exports to the US, up 7.6% in November compared to October. 2. The catch: this excludes gold. Why? Because Switzerland is the world's hub for refining gold. If a few extra bars of bullion move from London to Zurich, it skews the whole chart. So, real goods, watches, pharmaceuticals, precision machinery are up 7.6%. 3. Imports from the US, down 3.5%. 4. The result: the Swiss trade surplus with the US, the amount of money Switzerland makes off America, fattened up to 3.4 billion francs, up from 3 billion francs the month before. On paper, this looks fantastic. Switzerland, a nation that actually saw its economy contract in the third quarter of 2025 for the first time in 2 years, seems to be roaring back. But why? Did Americans suddenly develop an insatiable lust for Toblerone and Rolexes in November? No. This surge is entirely artificial. It is the result of a political lever being pulled. Specifically, the lever labeled "Please don't bankrupt us." To understand today's number, we have to rewind to the dark ages of 2 months ago. Throughout 2025, the US administration, continuing the aggressive tariff campaign we've discussed on this channel all year, decided that Switzerland was winning too much. The US looked at that trade surplus and said, "That's not fair." So, they slapped a 39% tariff on Swiss goods. Let that sink in. 39%. That is not a trade barrier, that is a trade wall. That is the highest level levied against any advanced economy. For a country like Switzerland, where exports account for over 60% of GDP, this was a cardiac arrest event. It's why the Swiss economy shrank in Q3. Their goods simply became too expensive for American buyers. The Swiss government, usually famous for its neutrality and slow, deliberate decision-making, suddenly learned how to sprint. On November 14th, they struck a framework trade deal with the US. The deal terms: 1. The US concession: they cut the tariff from the suffocating 39% down to 15%. 2. The Swiss price tag: in return, Swiss companies pledged a staggering $200 billion in investments into the US economy. 3. The side dish: Switzerland agreed to easier market access for American agricultural goods, specifically fish, seafood, and certain meats. Now, look at the timeline. The deal was announced November 14th. The tariff reduction was retroactive to the day of the announcement. That explains today's data. The moment the ink was dry, Swiss exporters rushed to clear the backlog of goods that had been sitting in warehouses, waiting for the 39% tax to drop. That 7.6% jump isn't organic demand, it's a release valve being opened. Let's analyze the cost of this business. The media is calling this a win-win. I call it a pay-to-play. The tariff reduction is a mirage. The tariff was cut to 15%. Friends, before this trade war started, the average weighted tariff was low single digits. A 15% tariff is still high. It's a massive drag on competitiveness. But because the alternative was 39%, 15% feels like a victory. This is a classic negotiation tactic: threaten to burn down the house, so the owner thanks you when you only smash the windows. The $200 billion investment pledge. This is the number that should make your jaw drop. Switzerland has a GDP of roughly $900 billion. They just pledged to invest nearly 25% of their annual GDP equivalent into the US economy. Now, let's be real, this is Boss Economic World, we know how corporate accounting works. Is this $200 billion in new money? Unlikely. 1. The reality: Novartis, Roche, Nestle, and ABB likely took investment plans they already had for the next 10 years, repackaged them, put a shiny bow on them, and handed them to the White House. 2. The strategy: look, Mr. President, we are building factories in Ohio. 3. The risk: if they don't hit that number, the US has the right to snap the tariffs back up. The fish in the Alps. I have to laugh at the agricultural clause. Switzerland is a landlocked, mountainous country. They are famous for cows and cheese. The US demanded they buy American seafood. Why? Because it plays well in American political swing states. Switzerland agreeing to this is symbolic submission. They are saying, fine, we will eat your frozen shrimp if you let us sell our cancer drugs. It shows how desperate the Swiss pharma industry was to keep the US market open. There is a fascinating detail in the Federal Register note mentioned in today's news. The retroactive refund, because the deal backdates the tariff cut to November 14, Swiss companies can now claim hundreds of millions of francs back from US customs. Imagine being a CFO of a Swiss watchmaker. You paid a 39% duty on a shipment on November 15. Today, you get to file paperwork to get 24% of that back. That is going to pad Q4 earnings for Swiss multinationals nicely. It's a liquidity injection right when they need it. But here is the trap. The note says the US will reconsider that concession if the preliminary agreement isn't finalized by March 31, 2026. This is the sword of Damocles hanging over Zurich. We are currently in the framework stage. That means they shook hands on the idea. Now the lawyers have to write the contract. If the Swiss drag their feet on the specific details of that $200 billion investment. If the Swiss health inspectors find too many hormones in that American meat. Boom. The tariff snaps back to 39% on April 1. This creates massive uncertainty. Business hates uncertainty. While exports jumped in November, don't expect a massive hiring spree in Switzerland yet. Everyone is holding their breath until March 31. So, why does this matter to you, whether you are a retail investor, a finance pro, or just someone trying to understand why your Swiss watch got so expensive? 1. The end of free trade, the rise of managed trade. This Swiss saga confirms the New World Order. The World Trade Organization is effectively a museum exhibit. We are now in an era of bilateral, transactional bullying. Old world, rules apply to everyone equally. New world, nice economy you have there. Pay me $200 billion or I crush it. If you are investing in export-heavy economies, take note. If Switzerland, the most neutral, diplomatic country on earth, can get shaken down, anyone can. 2. The Swiss franc dilemma. Usually, when a country has a massive trade surplus, their currency gets stronger. Traders buy francs to pay for those goods. The problem, a strong franc hurts exporters even more. It makes Swiss goods more expensive for foreign buyers. The central bank reaction, the Swiss National Bank is in a nightmare scenario. They have tariffs making goods expensive abroad, and a strong currency making goods expensive abroad. Prediction, expect the SNB to intervene heavily to keep the franc down. If you are a forex trader, watch the Swiss franc to US dollar pair around that March 31 deadline. Volatility is guaranteed. 3. Sector specifics, pharma is the kingmaker. When we say Swiss exports, everyone thinks of Rolex and chocolate. But the real money is pharmaceuticals and chemicals. These make up over 50% of Swiss exports. The US healthcare system relies on Swiss drugs. The Swiss economy relies on US patients. This deal was essentially a treaty to keep the medicine flowing. Investment tip, look at the major Swiss pharma giants. This deal clears a massive cloud over their heads. They paid a heavy price, but they secured their revenue stream. Let's sum this up in plain English. Switzerland's economy minister celebrated yesterday, saying the retroactive deal brings relief. And technically, he is right. If you are drowning, and someone stops holding your head underwater and instead just puts a heavy backpack on you, that is relief. The good news. Swiss exports are moving again. The immediate threat of a recessionary spiral in 2026 is reduced. Swiss companies are getting a nice tax refund check from the US Treasury. The bad news. A 15% tariff is a permanent tax on Swiss efficiency. Switzerland has mortgaged $200 billion of future capital to appease the US. The trade surplus is healthy, but it puts a target on their back. The US hates trade deficits. As that surplus grows, the US might come back for more. The truth, Switzerland didn't win a trade deal. They bought an insurance policy against total destruction. The government predicts slightly lower growth next year than they did before this mess started, which is honest. They know the glory days of frictionless trade are over. My take regarding the March 31 deadline, it will go down to the wire. There will be drama. There will be angry tweets. But ultimately, the deal will hold. Why? Because the US needs the drugs, and the Swiss need the money. It's a marriage of convenience, held together by a prenup that costs $200 billion. So, friends, when you see that headline Swiss exports jump, don't just see the green arrow. See the frantic negotiations, the massive payout, and the lobsters flying into Geneva. We are living in a world where economic data is no longer just about supply and demand, it's about leverage and concessions. The Swiss survived this round, but the cost of doing business just went up for everyone. Keep your eyes on the data, keep your powder dry, and remember, in the boss economic world, there is no such thing as a free lunch even if it comes with Swiss chocolate. I'll see you next time.